Welcome to the InterMarket analysis video update. This is a video that I do every week. And if you've been watching these videos for a while, there's really no changes this week. Even though we had a pretty negative down day on Friday, but it really started back on Thursday. But it hasn't shifted what we've been seeing lately, where growth is outperforming value. We're way overvalued, but we've been overvalued for years. So we haven't seen things really shift that much, at least to this point. Now, what we're going to be doing is watching to see if that shift continues as we head off into August, which often is a more negative time seasonally for the markets. But for right now, there was only one change this week, and it was actually positive. The mega caps just generated a golden cross. But other than that, nothing has really changed. All right, this is being prepared for Monday, August 4th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. First of all, I'll go through valuation. We look historically and looking forward. We've been overvalued no matter how you look at this for quite some time, but the market doesn't seem to be all that bothered by that. Then we go through growth versus value. Okay, we saw a little bit of weakness coming in here, but no real major shifts. Then we look at inflation, which seems to actually be subduing right now. Then we look at other markets outside of the stock market. We look at the 11 sectors that make up the S&P. We look at them individually, the chart just by itself, and then we do a ratio with the S&P 500 to see if it's underperforming, outperforming. Then we go through some different indexes, correlations between different markets, some very long-term trends, and then at the very end I have a positive and a negative list. All right, so first of all, it's valuation. Now, nothing has really changed here. We did come down a little bit with the S&P since we had a down day on Friday, but we're still well above the red dashed line. That hasn't changed for a number of years now, so that's still holding true that way. And this also shows that same thing, but just looking back more to 1980. Then the Shiller PE ratio, which is a variation of looking at historical data, it smooths it out over a period of time, coming in at 38, which typical of what we've been seeing over the last few years. It's more than double of what the median and the mean is for this particular indicator. We're still overvalued when we look at the mega cap 8. Even though it came down here, we're still at 28.4. We use that 10, 15, 20 scale, and we were getting close to 30. Now we're pulling back. We're still above 20 with the S&P, even though it's been pulling back, coming in at 21.8. And then more fairly priced are the mid caps and small caps, but they've been really underperforming actually over the last few years. Okay, this is another way of looking at this, and I went through this in the weekly video. I wanted to use this chart in this particular video where we look at that 10, 15, 20 scale. When we're at 20 or above, we're considered expensive. Here's the S&P itself, still coming in at 22, roughly. And then there are sectors that are even more expensive than the S&P itself. We have the industrials, which have been having a pretty good year. Discretionary, which is improving, but it's been lagging. And then tech, that's the big growth area. It's up over 30. Now, this was put out before the down day on Thursday and Friday. So these adjust every day. The earnings part of it doesn't adjust. That adjusts once a quarter. It's the price that changes every day. Then we still have staples and communication. Communication is growth. Staples are more defensive. That's still up around the 20 area, as are materials. And then we have things that are below that. And these are more defensive areas, healthcare and energy down around the fairly priced area, and financials. And we're a little bit concerned about financials, and I'll show you that. But it's been something that we've been concerned about for a while. Here's a chart put out by Bloomberg that says foreign inflows have helped push U.S. valuations to highs. All right, this came out throughout the week. It's probably come down a little bit. But you have folks that want to get involved in the US market, and that's pushing prices up. When prices go up, that pushes valuations up as well. Then we look at growth versus value. Even though we got hit pretty hard on Friday, we're still in an uptrend when we look at growth independently, and a little bit more weakness here with value. We actually fell below the 50 and 200-day moving average. It got taken down with everything else on Friday, but it held up a little bit better. Looking at the ratios between growth and value, and then the inverted chart down here, a little bit of a tick down, but no real change. Value is still underperforming growth. And we look at this a number of different ways. A couple of ETFs, we're still seeing where growth is outperforming value and value is underperforming growth. Look at some indexes. The growth index outperforming value, even though it pulled back on Friday. And this shows how value is underperforming growth. Then I do show this in the daily video. We just set a new high on Thursday. Well, we fell down on Friday. When we look at these ETFs of growth versus value, this is that same thing, but inverted, showing how value is underperforming growth. Then we look at the small cap growth to value ratio, pretty much going sideways, but it's still in an uptrend. Mid cap growth set a new high this past week, but falling back in Friday's session, also in an uptrend. S&P growth to value had a new breakout on Thursday, but then fell back on Friday, but still in a longer term uptrend. So what we're going to be watching for, especially this one, because I focus on the S&P 500, if this continues to fall, then we'll get more concerned. But right now, it just seems like a normal shift after we've had a pretty good run to the upside. Keeping an eye on inflation, this is a monthly chart. The CRB index, we closed out July. Now we're into August. We're still above, or barely above, an advancing moving average. That's a little bit of a concern longer term from an inflation standpoint. And then we do a ratio between inflation and deflation, where it had been really spiking up. Well, so far it's starting to level off a little bit, and the red line's starting to turn up. This is something in the bigger picture that we'll be keeping an eye on to see if this starts to increase. A daily chart of the CRB index still in an uptrend, even though it got hit on Friday with everything else. The Baltic Dry Index, another inflation gauge. What does it cost to ship products throughout the Baltics? Typically, when that's more expensive, the stock prices go up, and this is still in an uptrend. Inflation expectations actually came down. This is a weekly chart where we were getting a little bit concerned a week ago. Well, this now fell down. And then a ratio between inflation expectations and tips. These are instruments that folks get into. They're Treasury inflation protected securities. When the market is concerned about inflation and interest rates going up, they get into tips. When they think that inflation and interest rates are under control, they don't get into tips. They jump over and actually get into government bonds. And we're seeing this actually coming down lately with this ratio. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we look at aluminum, which is still in a downtrend. Also in a downtrend with corn, wheat in a downtrend. Fertilizer, it's been going up a little bit here. We've been watching this, not really breaking that much to the upside, but it's still going up. Lumber is in an uptrend, potentially inflationary there. Oil is kind of all over the place right now. It's still in a downtrend overall. A lot of this is geopolitical with things going on in the Middle East. We look at a correlation. Now you can see the dashed line, that's oil, and then the 10-year yield, that's been coming down. So shorter term, they're both going in the same direction, but this is still working into more of a neutral pattern with each other as they were decoupled. This goes back over the last 10 periods to measure the correlation. The gold to oil ratio kind of going sideways right now, not really seeing much of a change there. Gas is still in an uptrend, but really chopping sideways recently. Natural gas is in an uptrend, but has been pulling back. Heating oil in a downtrend, but it's actually bouncing up a little bit. Diesel, it really spiked up there and it's maintained those higher levels, but it's not really going up with as much energy as what we were seeing before. And copper, it just got hammered and it was up 0.29% on Friday. But the tariff news, copper had been going up, thinking that the tariffs would be more beneficial for copper. Well, that was kind of thrown out the window this past week. And so we saw a pretty big decline here. Now we're still in an uptrend and we still use this as a barometer of the economy. So we'll have to look at this and go, okay, did the market overreact? Because this thing can be quite volatile at times. But if this continues to go down, that might give us some concerns about the economy. And we look at a copper to gold ratio. When I did this a week ago, we were way up here. Now it's really going down. And it's not like gold is doing all that well. It's going sideways. It's the weakness in copper that caused this ratio to really fall. Longer term look at this same ratio where we've been declining, then it was starting to go back up. Now it's going back down. Just to give it a little bit more context, there's the 2-year yield and the 10-year yield also on this chart. Gold, as I've been saying, kind of right around its 50-day moving average. Now, I look at the ETF. I don't look at the futures contract. Silver also came down, but so far it's holding above its 50-day moving average. Then we look at a ratio. When this is going down, that means silver's outperforming gold. Well, gold's been holding up better as silver was under some pressure. And then we couple that up with the US dollar index, but we're getting pretty much of a neutral correlation right now. And the dollar, which did work its way back above 100, it got smacked on Friday, and now it's dropping back down into the 98 range and still in a bigger downtrend. Then we look at the euro, which has been going up against the dollar, but the dollar was starting to rebound, but that didn't carry through in the Friday session. Kind of going sideways here with the Japanese yen, also having the euro and the dollar here. Then I break these out where we're still in an uptrend, but you can see here that the Japanese yen is starting to underperform the dollar, but not enough to generate a downtrend yet. The euro, which had been seeing some weakness against the dollar, it really bounced back up on Friday, and pretty much the same thing with the British pound, falling under its 50-day moving average, but now bouncing back up. Some different indexes. We keep an eye on the weighted versus equal weighted version of the S&P. They're kind of going hand in hand right now. They're both declining. We're not seeing a real big disconnect right now. And so not much of a change, even though overall this ratio has been declining. That means the equal weight is underperforming the weighted version of the S&P. Then we look at the NASDAQ 100, which is holding up better right now than the S&P 500, but they're both doing good. They just got smacked on Friday after setting recent all-time highs. But this ratio still continues to go up, and that's positive. We're also going up here when we look at the stock to commodity ratio. This is still in an uptrend. This shows how commodities are underperforming stocks. And then the S&P 100, which are the biggest stocks that make up the S&P 500, even though they pulled back on Friday, they're still looking solid overall. Then the NASDAQ to S&P, NASDAQ has been outperforming, and that's usually more positive. Both can be doing good, but the NASDAQ has been doing even better. And the NASDAQ 100 continues to underperform the NASDAQ itself. And there's a couple of different ways to take this. This ratio going down, you could take that as negative, meaning that the big stocks, the NASDAQ 100, they're not showing as much leadership right now. You could take this as positive, meaning, okay, now that means the NASDAQ is outperforming the NASDAQ 100, and the NASDAQ is a lot bigger than the NASDAQ 100. So you could also look at that in a positive way. Mega caps to equal weight pulled back here, but still in a longer term uptrend. Mega cap growth did pull back, but still in an uptrend above both moving averages. And the robotics and AI ETF, which was really starting to break out here, it did pull back, but it's still above the rainbow. And it was starting to at least improve a little bit when we do a ratio between the robotics and AI ETF in the tech sector, but now it's starting to fall back down into the bottom end of the rainbow. The semi to tech ratio, we were getting concerned as this ratio is coming down. That means the semis are underperforming tech. And this was one of the warning signs that, okay, maybe we need to be a little more careful here. Now, it held up better on Friday, but overall, it still continues to decline. Small caps continue to underperform the S&P, also seen by this red line. This is the ratio going down as the blue line. The S&P has been going up. Dow Jones Composite Average just recently generating a golden cross here, but did pull back, especially in Friday's session. And small caps continue to underperform the tech sector. Low volatility stocks pretty much going sideways, but still in an uptrend, but not much of a change here. If this ratio really starts to go back up, that would be more defensive. This ratio is still continuing to go down. Then we take all the stocks, but we take out US stocks. And even though they pulled back, we're still in a pretty solid uptrend here, coming down and dealing with the 50-day moving average. Then we put the US stocks back into the equation, and this just shows how US stocks continue to underperform world stocks. And then we look at another ratio between energy and the tech sector, and this just shows how energy is underperforming tech. And growth is still outperforming bonds. Now, bonds had a really good day. It's more of a flight to safety. Interest rates really went down. Bond prices went up as stocks were under pressure. That's why we saw this 3.6 decline with the ratio in Friday's session. And we look at the tech sector to the 10-year yield, still showing how the tech sector is outperforming. This shows how the 10-year yield is underperforming the tech sector. So no real changes here. Discretionary to staples, we want this to be doing better. Recent golden cross here with the ratio, but it got hit pretty hard on Friday. And staples saw a bit of a bounce, but they still continue to underperforming in the bigger picture. Gold to stocks, still showing how the S&P has been doing better. When this was really going up, that means gold was going up and outperforming the S&P because the S&P was going down. We still see a basic shift where the S&P has been lately performing better. And then gold to the dollar, just kind of going along sideways as gold has been going sideways. The dollar did see some strength earlier in the week, but as I said earlier, got smacked pretty hard on Friday. And then we look at the advanced decline ratio, seeing some weakness here. We're dropping below the moving average with the NYSE common stock and the small caps. We're declining with the S&P and mid caps, but we're still above the moving average. And we look at traditional Dow theory, getting really close, but not quite there to an all-time high. Is this some kind of a double top here? Because we came back and matched what was set earlier on, and then we've been coming down with the Dow. The transports had been doing better, but over the last few sessions, they really underperformed. Where utilities are just kind of grinding their way higher, they really broke out, and that's usually considered more of a defensive area, and that's why it was actually up in Friday's session. We look at a ratio between the Dow and the transports. This had been showing some improvement. When this ratio goes down, that means the transports are doing better. But now the transports have been going down. The Dow's been going down, but less. So that's why we're seeing this ratio going back up. And here are the transports. We're starting to see some hope here, but it got hit pretty hard this past week. Also, looking at the ratio between the transports and the S&P, the transports continue to underperform. It looked like we were setting some kind of a base here and we were trying to go back up, but that's not happening currently. And then the correlation between the S&P 500 and the Dow transports starting to get a little bit stronger with that correlation. Then we use a new take on Dow theory where we use the S&P instead of the Dow, coming off of recent all-time highs. Instead of using the transports, we use the NASDAQ, also coming off of recent all-time highs. Then we break that down a little further. We look at the equal weight, which did set a recent all-time high, and then an equal weight version of the NASDAQ 100 that also recently set an all-time high. But you can see Friday's weakness is showing up here. The FANG index, these are the really big stocks, had been doing well, still in an uptrend, but got hit pretty hard on Friday. The Wilshire 5000, which is a broad market measure, still in an uptrend, even though it got smacked with everything else. And the total U.S. stock ETF, another broad market measure, in an uptrend, but got hit hard on Friday. Then we look at ARK, which has been doing better, and it's in an uptrend, but it was down 5.5% in Friday's session. All stocks, which are U.S. and international stocks, still in an uptrend overall, but seeing a pullback, at least in Friday's session. The NYSE composite coming back down to its 50-day moving average, but still in an uptrend. High leverage loans down a little bit in Friday's session, but still looking pretty solid overall. This is another barometer of the economy that we use, and so this is still looking good for the time being. Emerging markets are in an uptrend, but they were down on Friday. Bitcoin coming back down, still dealing with its 50-day moving average. Semiconductors setting a new all-time high with the SMH semiconductor ETF, but it got hit on Friday as well. This is that same ETF, showing how we're still, for the most part, at the high end of the rainbow. And then another AI and tech ETF setting a new all-time high, but pulling back on Friday, down 2.47%. And the microcaps, they generated a recent golden cross, but they were down over 2% on Friday. And then the Japanese Nikkei index still above this red line, so it's holding up a little bit better. And we look at the S&P and home builders, and then the correlation down on the bottom, still pretty strong. They're moving in the same direction at the same time. Then a longer look using the KST oscillator. We are still in an uptrend in China, but starting to roll over. We're starting to see a downtrend with emerging markets. We're in an uptrend in Europe, a downtrend in Japan, and we're still rolling over and looking more negative with the US. S&P 500 here. Then this is a monthly chart showing a long-term ratio between US and world stocks. Did come down with the latest reading, but still above this advancing moving average. And we're trying to come back up, but now leveling off when we look at the PPO of this longer term study. Bonds really shot up with the 10-year based on price. Still looking positive with the total bond ETF. That's based on price. And we have the stock to bond monthly chart still above the advancing moving average. And even though it ticked up here in Friday's session, bonds are continuing to underperform stocks. Bring World Bond Index in an uptrend here, but it has been pulling back. And we look at high yield bonds, which are junk bonds. These are still holding up quite well. And the Dow Jones Corporate Bond Index in an uptrend and coming back and testing these previous highs. Investment grade bonds, which are more conservative, they're also seeing a nice little upward move here. Then the stock to bond ratio having a slight tendency to go in opposite directions. And a lot of that was because of Friday. Bonds were up, stocks were down, and that's helping the shorter term correlation to actually show they're going in opposite directions here. Not much of a change when we look at junk bonds to more conservative bonds like government bonds, still hanging out near the bottom end of the rainbow. And the junk bond ETF just coming off of recent all-time highs, it was unchanged on Friday. And junk bonds continue to outperform more conservative government bonds on a ratio basis, still establishing this higher interest rate range that we've been seeing lately. That hasn't changed. And we saw a real drop off. This is a daily chart of all the US maturities and how they really came down. It was more of a flight to safety. And this is a weekly chart where we did see rates for the 10-year yield go down in the US, UK, a little bit down in Germany and Japan as well. And then we look at some stock to bond ratios. Even though we're coming back down here, this has still been pretty positive. Looking at the S&P 1500 with short-term bonds, also a bit of a pullback, but still overall positive. And the broad market measure, the 3 to 7 year bonds, took a bit of a hit on Friday. And then we're seeing the volatility of stocks really picking up. The VIX is now back above 20, where bonds are continuing to show lesser volatility. So we're coming back down to more of a neutral reading of this correlation when we just look at volatility itself. And bonds continue to underperform stocks, even though they did bounce back up in Friday's session. The tech sector to 3 to 7 year bonds, you're going to see a lot of the same things here. Really outperforming, but pulling back on Friday. And then stocks to the 10-year yield, stocks are still outperforming. A long-term look here at the 30-year bond, still in an overall downtrend with the moving average continuing to go down. And we do another ratio between the long-term bond and the CRB index, also showing how the long-term bond is underperforming. Now we look at the sectors. Here are the materials. Doing pretty good, just generated a recent golden cross and then spent a lot of the week just going down. And they still are underperforming when we do a ratio between materials and the S&P. And communication, this is a growth area, kind of going sideways a lot recently. And it came down and actually dropped below the 200-day moving average with this ratio, but it did bounce back up. Communication is it's holding up a little bit better right now when compared to the S&P, and we're seeing this kind of going sideways now. Energy, which is all over the place, still in a downtrend, coming back down to its 50-day moving average and continuing to underperform when we compare it to the S&P. Financials, this is causing a concern. We came down and actually closed below the 50-day moving average. This part is the concern. And we've been watching this for a while. As this ratio has been going down, that means the financials are underperforming the S&P 500. We dropped below the 200-day moving average, and we're getting near a death cross with this ratio. And industrials, still one of the better areas, even though they got hit on Friday with everything else, and still looking solid when compared to the S&P. Tech sector really doing well, setting a recent all-time high and then pulling back, and then still outperforming when we compare it to the S&P. So no real big shifts, at least yet. Staples continue to go sideways, but they still continue to underperform the S&P, even though they bounced up on Friday. Real estate just kind of chopping along, going sideways, but continuing to underperform the S&P. Utilities saw a nice breakout here. And I like to explain this. This is typically defensive, but you could make a case that it's a growth area as well because of AI, because of EVs, and the needs for electricity in particular. We're seeing this really showing some improvement here. And it's still it was coming down. We didn't quite get to a death cross here, but this ratio really spiked up on Friday. And we look at the S&P to utilities ratio, it's now coming down, which is more negative. When this is going up, that means the S&P is outperforming. Healthcare just really having a difficult time in a downtrend all by itself and underperforming the S&P on a comparative basis. Discretionary was doing okay. It was in an uptrend, but it got hit pretty hard on Friday, and it's still continuing to underperform the S&P. Semiconductors didn't come back with the SOX index. We still have a ways to go to get to the all-time high, but it was looking positive. But then it's now back dealing with its 50-day moving average. The Dow Jones Semiconductor Index did set a new all-time high this week, but is now pulling back. And this is long term. Just want to show these because it's like, okay, you look at just this and everybody's freaking out about what happened on Friday. There's really not much of a change with this long-term chart. And the semi, which is growth to Dow ratio, this is continuing to go up overall. And that's showing an improvement there. So gold is still in first place so far in 2025. Stocks are in second place. You got oil and commodities kind of neck and neck down here, and then bonds based on price, with the dollar still being in last place. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then the correlation's pretty much neutral when we look at the S&P to the dollar. And going in the same direction now when we look at the S&P and 10-year yield. So that's because stocks are going down and yields were going down, and that helped bump this correlation up. Then S&P to oil, neutral right now. Tech sector to the 10-year yield, okay, both going down right now. That's why this correlation is getting a little bit stronger. And then the S&P to the 2-year yield going in the same direction, as both have been declining lately. Long-term charts, this is a monthly chart of the NYSE, still looking good here, but we're still going down when we look at the Kopic curve momentum oscillator. Still going up here with the NYSE record high percent index. So that's still looking okay in the bigger picture. And then we look at the NYSE monthly chart again above the advancing moving average, but we're going down with the Kopic curve. And then the S&P monthly chart still above the moving average and trying to go up here, but starting to stall a little bit with this longer term momentum oscillator. Then the S&P on top, and then a ratio between stocks to commodities, showing how stocks are underperforming. Shorter term, on the daily side, stocks are outperforming. Longer term, stocks are underperforming. And then another US, the global look here, we're still above this advancing moving average, and the KST is continuing to go down as well. Then we look at all the positive things, and the list is still quite long. So I'll just kind of hold this up here right now and go all the way down to Bitcoin. Pretty much all the different markets that we look at are still looking good. It's a lot easier to just say, okay, what's negative right now? The dollar and small caps. Okay, small caps that still have yet to generate a golden cross. Mid caps are on this list, and now they got switched back over to the other side. Thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.